Hello, 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 and welcome, my friends. I am so glad you are here. This is Acquisitional Wealth, and I am your host, Josh Tully. If you are just joining us for the first time, I would strongly recommend going back and listening to Acquisitional Wealth, episode 1, because that's the one that everything else is built upon. So definitely make sure to go do that. And of course, while we're here and before we get too deep into today's topic, like the video if you're watching this on YouTube, subscribe, hit the bell, all that sort of stuff. If you're listening to the audio version of this, subscribe as well. And of course, share these with others. All right, so today's topic is probably the most requested topic we have. I'm going to say right out of the gate, there is way too much to talk about in one half-hour episode. So this is definitely going to have to be split up over multiple different episodes. So another great incentive, another reason that you should want to subscribe to Acquisitional Wealth. And that topic is, how much is the business worth? I know, right? The top two questions I get: how much is it going to cost me? How much is it worth? So we're going to talk about that how much is it worth question today, because it's not as simple as people tend to think it is. If you were to go online, which is usually the worst place to find information, but if you were to go online and Google how much is a business worth or how to value a business, you are going to run into an absolute mess, because nobody really knows. You're going to see things that say, hey, take EBITDA and multiply it by 3, take SDE and multiply it by 3, or maybe it's 1 times gross revenue, all of that sort of stuff. Is any of it true? Yeah, kind of. There's other indicators, it depends on the industry multiple. Tech companies have a higher industry multiple than, say, a bakery. Is that true? Yeah, kind of. Depends on the amount of revenue. A business that does $1 million a year isn't going to have the same sort of revenue as a business that profits $1 million a year. Is that true? Yeah, kind of. Are you noticing a trend? It's all yeah, kind of. And I'm not kidding, because the reality is there's no such thing as how much is the business worth. It's an abstract question. It doesn't even exist. And the reason it doesn't exist is because it's not something that can be defined broadly. And that's where this industry gets into a lot of trouble. There's this tendency to think, well, we can just standardize everything. We can create formulas and algorithms and data. No. So in order to get to the value of a business, we need to take a step back. We need to ask ourselves, what's the difference between price, cost, and value? Because those are 3 separate things. In today's world, we are very accustomed to just saying, hey, how much is something? And, at a store or something, pick it up and there's a sticker on it, or go online and it says right next to it what the price is. And we take that mindset and we try to apply it to businesses. We try to apply it to this idea of buying and selling a company. And it doesn't work that way. So that's problem number 1. We're looking for just a standard price. No. What is cost? Cost is what, not to kind of sound redundant, but cost is what it costs you. That doesn't mean it's necessarily the price. So for example, let's say I wanted to buy a cowboy hat, and I make $10 an hour, and it's a $200 hat. Now you might make $1,000 an hour, and it's still a $200 hat. The price is the same, but the cost, completely different. Completely different. It's going to cost me every part of profit I make for a week to buy that hat. It's going to cost you what you make before lunch to buy that hat. See the difference? Same price, much different cost. And I know when I explain that to live audiences, they go, but it's absolutely true. Well, now take that difference between price and cost and multiply it again, and that's where we get value. Because value is really determined by the person doing the purchasing. It's really determined by people doing the purchasing. So, for example, I have a Dick Butkus rookie card. And if you don't know who Dick Butkus is, you're kind of proving my point. Dick Butkus was a football player for the Chicago Bears. Pretty good football player at that. The rookie card I bought it last century, and I bought it for like $10, I think. And the last time I looked it up, it's worth like $190. It's worth that. Now, is that what I'm going to get for it? No. Because the reality is I only get what somebody's willing to pay for. See the difference? It could be worth $1 million, and if nobody's willing to give me $1 million, doesn't matter. It makes no difference at all. Doesn't matter what the appraisers say. Doesn't matter what, the insurance adjuster says when they go to insure it, which they're probably never going to pay you the whole amount anyway. So it's completely irrelevant. Well, that same thing is true when it comes to how much is a business worth. So are there some things we can look at? Yes, there are. We can look at things like SDE, seller's discretionary earnings. We can look at things like EBITDA or EBITDA. And if you don't know what those are, it's earnings before depreciation, amortization, interest, taxation, all that sort of stuff. And I think I might have got that out of order, but you get the point. We could look at gross revenue. We could look at gross profit. We could look at whatever sort of indicator. And is that necessarily bad to start there? No, as long as that's where we start and not where we finish. Does that make sense? And then can we take industry multiples? Yeah, as long as that's where we start and not where we finish. Now, I'll be honest, if you're looking at a business typically up to $2 million, you're usually going to be looking at somewhere around 3 times whatever SDE or seller discretionary earnings are. That's kind of typical in terms of just across the board industry valuations. Does that mean that's what you should pay? No. Does that mean you should pay less? Depends. Does that mean you should pay more? Depends. It depends. It all is determined by what that business means to you. Does that make sense? So let's say you have a fairly successful bakery. And the bakery does $200,000 a year in SDE. We could easily take it to market and say, well, if it's doing $200,000 in SDE, let's multiply it by 3. That gives us $600,000. And we're going to say, somebody could buy this for $600,000. Now, what we do know is that 50% of all businesses that go up for sale will never find a buyer. Well, that hurts your value, just FYI. But we also know that to the right buyer, it's worth way more than $600,000. Way more. And that's where this becomes more art and less engineering. And I would say that this is probably one of the largest problems in the whole business transaction M&A world today. And that's this idea that we can somehow make this an engineering problem, a math problem, and come to a simple mathematical conclusion, and that's going to paint an accurate valuation. And that is such an immature, irresponsible position to take. It's nauseating, and it has cost people millions of dollars. So let me kind of explain a little bit deeper. Let's say you owned 3 bakeries already around your state, and you really want to open that 4th one. And this business, according to the SDE sort of calculation, should go for $600,000. But you already know that it costs you about $1 million to scout a new location, get lawyers, get construction people, get architects, build a new store, staff it for 2 years before it really starts making money. All the loss in that 2 years, it takes about $1 million out of your pocket to open up a new location. So how much is that business worth to you? Anything under $1 million makes sense. Would I pay $900,000 for it? Yep, every day. Because it just makes sense. So you might be thinking, well, wait a second, then how do I know how much I should be paying for a business if I'm going to be the one acquiring the business? It's all dependent on you. How much is that business worth? Now, let's say you've decided, and sometimes it's worth a lot less. Sometimes it's worth a lot less. Let me give you another example. Let's say you have just a no-name locksmith company, and you do $1 million a year, $200,000 in SDE. And you Googled how much is my business worth, and you come up with this idea that it's 3 times multiple, and you think, okay, well, I'm going to sell my locksmithing business for $600,000. No, only an idiot would buy it for $600,000. Why? Well, typically, in a locksmithing business, you don't have contracts with supplier or customers. You don't have anything that's really proprietary, nothing unique, no customer loyalty. It's not something that somebody's going to need this month and then call you again next month. It's largely, there's a problem. We look up locksmiths in our area and we call somebody. Well, what that means is, why would I pay you $600,000 for a business that I can start for $10,000? And if I put another $20,000 into marketing and advertising, I could quickly beat you in the next 90 days for a fraction of the cost that you think your business is worth. And this is where a lot of business sellers kind of get their emotions hurt, because they think, well, I've been doing this for 20 years. My business is worth so much more. Matter of fact, it's worth more than $600,000. You need to give me $1 million for it. No, because you don't have anything of value. Now, price-wise, yeah, the price is there. The calculation's there. But is that what it's actually worth? Oh, God, no. No. And that's when a lot of these business owners realize you don't really own a business. You own a nondescript service provider that somebody else can compete and beat you in the next 30 to 90 days with $10,000. So no, I would never buy that. Matter of fact, for the same $600,000 to buy you, if I could start for $10,000, I could open up in 60 different markets and quickly become the dominant player for the same amount of time, money, and effort that it's going to take me to buy you. See the difference? And I know if you're a seller, that kind of hurts, but it's the absolute truth. And if you're a buyer, you're kind of incentivized by that, and you should be. Unless, of course, you have to pay more than what the 3 times is, like in the example of the bakery, where, yeah, you should pay $900,000 for it, because it's going to cost you $1 million to do it without it. Now, let's be real clear. Does that mean that's what you're going to have to pay? No. And of course, there's negotiating, there's financing, and all that sort of stuff. But you really have to get down to what is a value. What is a value? Not what is a discount. But when I say what is a value, what is it? What is it in this business that you value? And I remember I learned this very early on in my business brokerage sort of M&A career, when I helped a guy who was selling his business for $8 million, or at least trying to. He listed it with 2 of the well-known business broker M&A brands, and both of them failed to sell his business. And I was helping him with some other business stuff at the time, because I've been in business now for, I think this is my 27th year. And I was watching this process and watching these brokers fail over and over. And I said, hey, can I give this a shot? So I became a business broker, and I ended up selling the business for $20 million. Yep, true story. Because I found the person who valued that business enough to pay that price for the value. Does that make sense? Now, how does this apply to most of you? Most of you, if you're watching Acquisitional Wealth, you are buying your first, second, or third business, typically. That's who we're talking to. And this applies to you in a way that's beyond just the math, right? So we've already kind of talked about the difference between price, cost, and value. Check. But unless you're just going to pay for a business with cash, you're going to have to finance this thing. And that's where this becomes a problem. Because you and I, the listening audience, understand the difference between price, value, and cost. However, the bank doesn't always get it. And worse yet, is the other player, which we'll get to in a second. So let's first cover the bank. So you go to the bank and you're going to say, hey, Mr. Banker, I want to buy this bakery for $900,000. And the bank is going to look at the second worst piece of data to look at, which is past performance. And they're going to look at tax returns. They're going to look at their balance sheets. They're going to look at their cash flow statements, or what's called profit and loss statements now. They're going to look at all this information and other information too, and they're going to kind of come up with a valuation. They're going to multiply it themselves, and they're going to say, boom, this is what it's worth. Now, typically, just FYI, a bank is not going to lend you, typically, 100% of what they deem the value is anyway, which is why typically there's a down payment involved. Banks like to stay at 80 to 90 or less percent of whatever the perceived value they give the business is. That way, if this thing all goes to hell in a handbasket, they have something to liquidate and kind of make their money back. Of course, you have SBA loans in there that help. And of course, if you're doing a roll-up, that really helps because that's more of an expansion loan. And a lot of those you can get for zero money down, but that's a whole nother story and another episode, actually. So I digress. But let's just go with this idea that they're looking at the financial data and they're going to say, well, it's not worth $900,000. If they have an SDE of $200,000, then we're going to give you 3 times multiple, and that's $600,000. Now, at this point, we need to take a tiny little time out and explain something. Where did we get SDE in the first place? Where do we get that number? There's no real spot on the balance sheet that's going to give you that number, not an accurate number. You're going to have to do, or your hired professional, whether that's an accountant, lawyer, lawyers don't really do it, but you get the point, business broker, so on and so forth, investment bank, whatever. They're going to do what's called recasting your financials. And they're going to take that information and alter it a little bit. And because I try to keep these episodes to 30 minutes, I don't have time to go into it, but let's just do a quick little example. Let's say on the expenses side of things, you have season tickets to the Houston Astros. I happen to be in Houston. You have season tickets to the Houston Astros. Is that legal to write that down as an expense? Yeah. However, you don't take the number after that and say, well, this is what we make. No. Does the new owner have to keep those season tickets? Of course not. So what your hired professional will do is they'll take the value of those season tickets, or actually the price of the season tickets, not the value. They'll take the price of those season tickets and put it back in as if you didn't spend it. Does that make sense? And they'll go through the entire thing like that, and they'll make notes, and there's a system and there's a whole system behind it, but they'll do that, and they'll get a recast financial. Now, here's where this gets a little sticky wicket. If you take your financials to 5 different valuation professionals, you're going to get 6 to 8 different valuations. And I'm not even kidding. I'm not saying that to just shock and awe. I'm absolutely serious. Because some of those professionals are going to make 2 sets based on varying factors. So you're actually going to get more numbers. My point is they're never going to all be the same. Never. So that creates another big problem when we go back to the story where we're at the bank, right? So the bank says, okay, it's $200,000 times a 3 times multiple, so we're going to let you sell this thing for $600,000. Well, maybe, if that's what that bank came to. You could take it to the bank across the street, they'll get a different number. Now, quick little asterisk, does that mean you should shop it around to a bunch of banks? No, that's not what I'm saying. All I'm saying is don't think that this is a locked-in science, because it's not. Okay, so you went to the bank. They said $600,000. You agreed to buy it for $900,000 because it's totally worth it. Totally worth it. Now what? Well, depending on the bank, depending on the situation, depending on if it's going to be an SBA guaranteed loan and all that sort of stuff, the bank might not let you buy it for $900,000. I'm not kidding. Well, wait a second, Josh. I mean, if the seller agreed and the buyer agreed, what business is it of the banks? The bank's only underwriting the $600,000 loan. Can't I just buy it, give the guy an extra $300,000? Not really. In concept, yes, but not really. I've been involved in so many deals where the bank tries to somehow think they're business experts and say, no, we're going to put the value at this, and we don't want to see this much carried on seller financing, which we'll talk about later. We don't want to see that much carried on seller financing and yada, yada, yada. And it's again, immature and irresponsible, but that's the world we live in. And that's the problem. And the more that these banks go to sort of cloud-based virtual data collection center, just kick out the equation sort of lending, the worse this gets. And what's sad is they think they're improving the industry. They think they're adding to society, and they're not. And I know that's probably, if you're a banker, that probably stung a little bit. I don't mean it to be that way, but it's not. It's totally damaging the industry, and it's demonstrably true. And then we add in this other element, and this other element is what really kind of sticks a sticky wicket in here. Typically, what's going to happen is the bank's going to do their first set evaluation, typically somebody in the bank. And then if they think they're really going to underwrite this thing, they're going to go back and they're going to have an independent valuation done. This is where this kind of hits just crazy town. They send the financial information to a third-party independent company. This company is going to just look at the financial information. I know, it's that stupid. They're going to look at the financial information, and they're going to say, well, we're going to give you this 60, 70-page report as to why we think the business is valued at XYZ. Now, I've been doing this forever and a day. I've been buying and selling my own businesses since 1995. Helping other people since 2017. So I've been doing this a minute. It is 2023. So I've been doing it for a while. I've never, ever seen a third-party valuation company that just does what I just described come anywhere near reality value. And what's really, really kind of twisted in sort of a Twilight Zone, you can't believe it sort of way, is this, unfortunately, is what the SBA kind of uses as kind of the framework or guidelines for determining value of a company. I wish I was kidding, but I'm not. So, again, these companies think that they're awesome and they're doing some sort of wonderful service to streamline, financing and help America grow business. Absolutely demonstrably the opposite, but they exist. So, what are you going to do? So they're going to give you a number that's so far in my 28 years, absolutely incorrect. You're going to have to deal with it though. So now you have a gap, and the gap is where you have to start getting creative. Work with your skilled broker. That's why it's important to have a skilled broker to somehow bridge the gap, if possible. But just be ready and acknowledge the fact that even though you and the seller, or you and the buyer, depending on who you are, have already agreed upon a value, that doesn't mean that that's the price that it's going to go for, and it's certainly not indicative of the cost. So what does that all mean? I mean, we're kind of wrapping up this episode. What does that all mean, except I'm assuming it leaves a lot more questions than answers, and you wanted some sort of easy Google, just sort of tell me how this works sort of scenario, and it doesn't work that way. You really have to look at, for you, what the value is. And I know I say that, and it almost sounds like cliche at this point because I've said value probably 20 times in this episode, but it's absolutely true. How much is it worth to you? And let's say you know that the bakery is not staffed correctly. You know the bakery is not making donuts correctly. You know the bakery doesn't want to deliver donuts, and there's demand for it. They just have never had the ambition to add delivery service. They've never went after corporate contracts like gas stations or hospitals or whatever, right? And you look at this business and you're thinking, holy cow, dude, I would pay $1.3 million for it if I could get it, right? Well, the bank is never going to see that. They're never going to see that. And As much as the banks are like, yeah, well, we invest in the future and paint a picture for us as to why you think the business is worth that. It doesn't really work that way most of the time. So you're going to have to create a way to make up the gap and to get really good at negotiating. That's all I'm going to say about that. Yeah, that's all I'm going to say about that. At the end of the day, just walk away with this. Know that the value of the business is completely up to the individual purchasing it. And that price should always be weighed with the cost associated with it. Knowing that cost, value, and price are three separate and totally distinct elements. They're not remotely related. They're not interchangeable words or they're not interchangeable words. So there you go. All right. I hope that helps a little. I'm telling you, I'm finishing up this episode thinking that probably didn't help at all. Probably made people really, really confused. Again, that's why you have to really rely on trained professionals. But I do hope it helps. It at least gives you the understanding that the bank and the valuating company that the banks use are the least two reliable sources when it comes to how much a business is actually worth. And the real value is determined by what that business means to you and your strategy, your goals, your current system setup. Is this your first business? Is this a roll-up? Is it an expansion? Is it, what is it? All play into how much is it worth. And this is 90% art, 10% math. And I'm going to be straight, blunt, honest. The industry is getting polluted by people who come in with, sort of the accounting sort of background, the engineering sort of background, and think that the M&A industry can be a mathematical equation. It is just destroying the industry. So when at all possible, try to avoid that. But I know that it's not always possible, especially to the audience we're talking about and talking to when many of you are buying your first, second, or third businesses. And we consider that beginner phase. And it doesn't matter the size. It's not like, well, I bought one, Josh, but it was worth $30 million. I don't care. I mean, that's still a baby. You're still buying your first business. Too many times people look at the money as opposed to the score. And the score is not kept by money. Money is the fuel. The score is the accomplishment. So I look at the score, not the amount when it comes to are you experienced or not. So that does it for today. Remember, if you're watching this video, like, subscribe, share with other people, hit that bell notification. If you're listening to this on audio, subscribe there as well. Share with other people. And before I get out of here, I do want to mention the website, acquisitionalwealth.com, kingsbridgebrokers.com. Thanks for sponsoring the show. I'm kind of thanking myself there, but tongue-in-cheek comment. And also, there was one other thing I was going to say. Oh, yes. The Facebook page and Facebook group. Go to Facebook, put in Acquisitional Wealth. You'll find us there as well. No, we do not charge for our digitally delivered content. There's no sort of coaching program or mentorship program to sign up for or rip you off with or whatever. We are offering all of this for free. All this content is out there anyway for free. We didn't invent any of this. It's been around for 6,000 plus years. Buying and selling businesses is not new. There's nothing, whoa, this revolutionary new. Nope. The only interesting, unique element to this industry is the strategy. The strategy, negotiation, deal structure, stuff like that. One that can't be taught digitally through mentorship online programs anyway, so we're not afraid of that. Just bottom line, we're here to help you. There's no, click funnel or opt in or opt out in any of our stuff. We're here to give it away now. A little chili pepper reference for you. So feel free to join us, and I look forward to seeing you on the next episode.